So, welcome to the Real Estate Investment Club. Today is Friday, June 5th, 2020, and we're going to start with about 5 minutes worth of announcements and then introduce our guest speaker. So, the first announcement is that we do have a Inside Blue group called Real Estate Investing Club, and here you'll find all the previous presentations, including this document called Links to Recordings and Slide Decks of Previous Guests. And here I just put in a nice table format all the different guest speakers that we've had before. So for instance, if you're interested in short-term rentals, Tim Hubbard gave a great overview. He's a full-time short-term and rental investor who has worked on it before. Down here, Eric Tate talked about alternative real estate investments like coffee farms in Colombia. I gave a presentation on real estate syndication. I do own a business where I work with investors to buy apartment complexes. We have investing in farmland in the Columbia River Valley by Stu Kerber. So for those who are interested in Portland and local investing and basically coming together in a partnership and syndicating a piece of farmland, you can check that out. Kathy Fetke, she's been on MSNBC, Wall Street Journal. She's a well-known commentator, and she gave us a state of the economy after COVID-19. Sam Wilson talked about syndicating parking lots. And in case you don't know what syndication, it just means a group of investors coming together to purchase something. But parking lot investment. And Courtney Buck is a real estate investor from the CDC, or he works at the CDC as an ambassador to the WHO. And he's also a real estate investor, and he came in and talked to us. So we've got lots of interesting talks here. I actually thought that the 2 weeks ago our talk, Brad St. Orange, was a really great talk also. He was talking about investing in farmland in South America and just gave a very highly data-driven presentation. We also have several presentations on self-directed retirement accounts, and particularly actually towards the beginning of the meetings, we had quite a few of those. So that is the first announcement here. The second announcement is that if you're not receiving regular updates for when these meetings occur, be sure to go to meetup.intel.com and find the Real Estate Investment Club. Once you do that, you'll see a follow link over here that says follow or unfollow, and you can do that in order to receive updates about when these meetings are. One caveat that I'll give you is that the emails that meetup.intel.com sends out are really ugly emails. They're really. I wish I had the ability to customize them more. They look awful. Apologies to anybody on the team that's working there. But so on occasion, I do take the list of people that are subscribed to the Real Estate Investment Club and then send out a customized email. Sometimes you'll see that email coming directly from me rather than from meetup.intel.com. And if you want to unsubscribe from that, you can go here as well, or you can just email me and I'll be glad to take you off. And then lastly, we have Bob Moman coming up next week. He's going to be speaking in investing in commercial office space during COVID-19. And he's got a couple of commercial office parks that are continuing to perform well, and he's going to give us some insights as to what he's doing there. After that, we have nobody for about a month that is scheduled to come in and speak. So I will do some work on getting the speaker on first-time home buyers to come up in hopefully in 2 weeks if their schedule aligns. And also I'll look for that person on real estate investment trusts. Lastly, if you are interested in having a smaller group discussion, this tends to be a larger meeting and it's not necessarily conducive to discussions, but we do a Tuesday at 11:30 Pacific time, just an informal like pre-luncheon discussion. So if you've got questions about, your rental home or how we had a person in there last time who just bought a duplex and they were living in one side and they had a tenant in the other. If you have any questions at all, it's just a friendly discussion group. It's kind of like a breakout group, a small group breaking out of this larger one. So if you are interested in that, I'll send an invitation around for that, and feel free to sign up. Tuesday, 11:30 Pacific time. So So right now, I would like to introduce our guest speaker, Adiel Gorell. And Adiel Gorell is an ex-Silicon Valley engineer. He's also taught at Stanford. For 35 years, he has helped thousands invest in solid single-family homes all over the U.S. and changed thousands of lives in the process. Adiel was invited to create the PBS special Remote Control Retirement Riches, a television show which aired all over the U.S. and in the San Francisco Bay Area, it aired on KQED. Adiel is a very big investor himself and has helped people buy over 10,000 properties. He focuses on making investments efficient and simple so that it does not impinge on the busy daily lives of the investors. So Adiel, welcome to the group.
Thank you very much, Daniel. It's a pleasure to be here today. I'm looking at your screen still.
Yeah, I'm going to stop sharing.
Yeah.
There we go.
So thank you everyone for being on the line with us. It's really a joy to be here. And Daniel, thank you for bringing me on. When I see Intel, I can't help but remember that when I was working in a startup, after I left Hewlett-Packard Labs in Palo Alto, we needed very strong computing power. We were working on folding proteins for a biotech startup, and I struck a deal with Intel to let me use their massively parallel machine somewhere near Portland. I don't remember the suburb exactly, but I went to Portland many times and worked on your machine, and it gave us a lot of power to do the protein folding. So I have very sweet memories of that. I would like to introduce myself by way of a background.
Your call.
Can you hear me, Daniel?
408.
Yes, we can hear
7.
you. I'm going to go around and mute people that are just attending. So if you could please mute yourself.
Okay. So I was born in another country, as you can hear from the way I speak. I was born into a family of real estate developers. So as a little boy, not that I cared very much, but around the dinner table, I would hear my family talk about houses and apartments and real estate, whether I wanted to or not. And what stuck in my mind were two sentences, primarily. Both of them were accompanied by the following hand motion. The first one was, why didn't we buy these homes 10 years ago? They were cheap, we could have, we should have. And then the second one was, why did we sell these homes 10 years ago? They would have been so, okay. So as a little boy, my family walked around with dents in their forehead, but I took the message that to own homes is a good thing. I came to the US to do my graduate school at Stanford in electrical engineering, nothing to do with real estate at all. And I taught at Stanford, which was really a lot of fun. And then my first job was at Hewlett-Packard Labs, which is very near Stanford, so I could live in Palo Alto in the same place, still continue my research at Stanford, and also do my research at HP Labs. Now, when I started working at HP Labs, two things happened. Number one, I moved from becoming a poor student at Stanford, on a scholarship, to being a highly paid engineer in Silicon Valley, or at least it seemed like a very high salary. So I was happy about that. Now, the second thing that happened was I was a very young guy, and my colleagues at Hewlett-Packard Labs were veteran engineers, many of them also in their 40s, 50s, even 60, because the labs has a lot of veterans. I looked at them and said, what do these people look like after working here for 20 or 30 years, making the excellent salary that they pay you in Silicon Valley, which you guys know all about? What do they look like financially? And frankly, I was not impressed. My typical colleague at age 50 or 60 had their own home, a 401k, and that was about it. I said, there is no way that I'm going to work here for 20 or 30 years and this is what I'm going to look like financially. Remembering my childhood, I said, I'm going to start buying homes, single family home investments right here in Silicon Valley. That was in the 1980s. I know, I started when I was 1 year old. No, I'm older than that. So I was living in Palo Alto. I think the first home I ever bought was in Sunnyvale. Then I bought some in San Jose. But very quickly I realized, even in the 1980s, when the numbers were completely different, when the numbers were very, very different than they are now, the numbers didn't work in Silicon Valley. The rents were too low relative to the home prices. For example, if you promise not to laugh, I was living in a home in College Terrace in Palo Alto.
Some of the most intense riots and looting in the entire country you could see.
Near Stanford, and I was paying in the 1980s $700 a month in rent. I know it sounds funny, for Palo Alto. I could have bought the home for $150,000, which sounds amazing. But again, the ratio between 700 and 150,000 is not a good ratio. Back in the beginning of the 1980s, there was an unwritten rule in real estate investing. It was only buy within 30 minutes drive of where you live. And everybody followed that rule. I saw right away, if I follow that so-called rule, I will not be able to buy anything meaningful in Silicon Valley and sustain it. I didn't just want to buy one home or two homes. I wanted to do it on an ongoing basis so it can change my future, so that I get to age 50 or 60, I would look completely different. Well, at the time we didn't have the web, and Sergey Brin and Larry Page were in kindergarten, I think. But still, I had the ARPANET at Stanford and the library, and with a little research I saw that if I took a plane for an hour and a half and went to a smaller city called Las Vegas, which at the time was 425,000 people. And people were saying crazy things about it. They said it was going to be 1 million people by the year 2000, which, by the way, in hindsight, Las Vegas grew to 1.25 million by the year 2000. When I got to Vegas, I saw similar homes to the ones in Silicon Valley, but they cost 4 times less, and they rented for a little more than half. Those were numbers that were completely different and worked very well. So I broke the so-called rule of buying close to where you live, and I started flying to Vegas every weekend. It took me a couple of months to get my bearings. I needed a good local broker to find me good homes. And most importantly, I needed a local property management firm because I was living in Palo Alto in California, and I was buying homes in Las Vegas. In a couple of months, I had those teams working, and I went about it very aggressively. In my first year in Vegas, I ended up buying 22 homes. It's not as impressive as you might think. If you promise not to laugh, I'll tell you that the average home I was buying in Vegas back then cost a little less than $40,000 for the entire home. Those were the days. It was different times. And Fannie Mae allowed me as an investor back then to put only 10% down. And there were circumstances where sometimes I could put only 5% down. So financially, it wasn't very daunting to buy 22 homes, but maybe it was good that I actually did it rather than go to 1 million meetings like all my friends did, where they never bought very much. So my friends in Silicon Valley made a lot of fun of me during that first year when I was buying in Vegas. They said, "What are you doing? You're breaking the rule. You're buying out of state. You're crazy." But, my friends were mostly engineers in Silicon Valley firms. And we, engineers, as you guys are, I'm sure, are logical people. So once they saw me buy my first 22 homes, they started saying, "We understand what you're doing. It makes sense to me, and I would like to join you." I said, "You don't need to join me. You just do it yourself." And they said, "No, you're already there. You have your managers. You seem to be comfortable. How about you lead us?" I said, "Okay." So I led a group of about 20 engineers from Silicon Valley, and we ended up buying about 250 homes over a period of 3.5 years in Las Vegas, not as a group, She bought 4 homes, he bought 3 homes, I bought another 2. But the property managers and brokers knew very well that even the Swedish engineer who was a little scared and bought only 1 home as a test, if he wasn't happy with them, he would tell me about it. And then I will call them, and they know they could risk losing 250 homes, not just his own home. And every other manager in town was calling me all the time, move to us, we're cheaper, we're better. In other words, it's good to be a large client. About 1987, Las Vegas prices started going up. So we stopped buying, and I moved the entire operation to Portland. We were buying in Portland. Now you might ask why. The property taxes in Oregon are super high. But back in the 1980s, it was low priced and the numbers worked. Developing the team that we needed, property managers, brokers in Portland, was much easier than it was in Vegas, because when they saw this young man coming and saying, oh, we're going to buy a lot of homes, and they said, of course, you're not going to do anything, leave me alone. All I needed to say was, would you like to talk to our Las Vegas property management? And when they got off the phone with the Vegas managers, they really wanted to work with us. So it's always much easier to create an infrastructure in a market to serve us when we live out of state the second time around, or the third. We bought in Portland for a very short time because the end of 1988 started the boom. What boom? You guys are probably familiar with the boom we had between 2004 and 2006, preceding the big recession from 2008. But the boom previous to that was from the end of 1988 through the year of 1989, and it also was followed by a recession from 1991, 92. So we didn't end up buying a lot of homes in Portland because the boom came. So I moved the entire operation to Phoenix, Arizona in 1989. By that time, things started to change. People heard about the crazy guy in Silicon Valley who was buying homes out of state. And I started getting invited to speak to many investors club, the same as all of my friends would go to all those years, and they never really did much. But in one of those meetings when I spoke about what we were doing, unbeknownst to me was a reporter for the San Francisco Examiner, which used to be a big newspaper here in the Bay Area. In the Sunday paper, there was a big article, about us and what we are doing, and the whole thing exploded. I also saw I was enjoying myself a lot more helping people and buying so much myself that I actually ditched my Silicon Valley career. I had left Hewlett-Packard Labs to join a biotech startup. That's when I was working with a supercomputer at Intel. And when the startup died, as many of them do, I decided not to go back to high tech. It was a little scary because I was used to getting my salary. But that's what I've been doing for 36 years now. We, incorporated. We've been in about 35 markets. I'll talk about where and why. And our investors worldwide have bought more than 10,000 homes, where I myself as an individual over the years bought a little more than 400 homes, of which I still own quite a few. Now, Phoenix, where we moved in 1989, became our biggest market. Over 21 years, our investors and me and my friend bought more than 3,000 homes. Now, one thing that I discovered right at the very beginning is something that you guys know very well, except very few people think about it. Even the great Warren Buffett didn't think about it. So when I was doing the PBS show, I was telling the crowd, those of you with a very keen sense of hearing may have detected the fact that I speak with an accent. So they all laugh, right? Because I do. I say you pretty much have to speak with an accent to realize something very special that exists in the United States that doesn't exist, to the best of my knowledge, in any other country. To you, it's going to be very familiar. It's the 30-year fixed rate mortgage. So you're thinking, what's new about that? There's nothing special here. Oh, there's something very special. So let me illustrate by saying, here's what happens when I speak in Europe, when I can travel, that is. So I tell the Europeans My investors in the US can get loans that are 30 years fixed. That means the monthly payment never changes with inflation. It's fixed. And the loan balance, even though it goes down with the principal payments, also never keeps up with inflation. The Europeans' reactions is always very strong. It goes along the lines of, excuse me, sir, but it appears you don't know what you're talking about. What you're saying is impossible. Nobody will ever lend you money where for 30 years the mortgage payment or the balance will ever keep up with inflation. We know you have inflation in the United States. And 30 years ago, when you bought a postage stamp in the United States, you paid 4 cents. Now it's 50-something cents. 30 years ago, you went to the movies in New York for $2. Now it's more than $14. You have inflation in the US. The dollar buys less and less all the time. You want to tell us that somebody's going to be crazy enough to lend you money for as long as 30 years where nothing will ever change? If that were to be true, which is impossible, they say, it means inflation will constantly erode the real value of your loan, making it look like a joke, not in 30 years, but probably in 10 or 12 or 14 years. That's impossible. It's too good. It's too much of a gift. Obviously, you don't know what you're talking about. QED. So I always say, look, I see you have these very nice phones. Do you care to do a little search? They do the search, and then comes the moment I call the sheepish face moment. They say, oh, apparently there is such a loan in the United States. I don't think loans like this exist in any other country for 30 years fixed. And the next question is always the same. If the Americans can get this unbelievable financial gift where somebody lends you money and inflation erodes it day in and day out, why don't the Americans run out every day to get as many of those as they can? My answer is always the same. I don't know, but I do. And right there lies the core of what home investments can do for your future. It can transform and change your future completely because you don't have to wait for 30 years. 10 years, 12 years, 14 years, inflation has eroded your fixed loan to a point where it kind of looks like a joke. Here is a real story. I may have mentioned it on the TV show. I have a friend here in the San Francisco Bay Area. He's a doctor, a neonatal specialist. He was buying homes with us in the beginning of the 2000s, where one of our biggest markets was Phoenix. Phoenix is not appropriate now. It's too expensive, but he bought one home to try it out, liked it, because he's a busy doctor. He doesn't have a lot of time. We'll talk about that soon, too. Then he bought another one. He ended up buying 19 homes. Again, not that impressive. Probably the homes he bought, brand new, cost $140,000, and back then, Fannie Mae still allowed him to put only 10% down with PMI, which he did. So he calls me up 2 years ago at the age of 58. This year he turned 60. He says, here is what my typical home in Phoenix looks like. The home is worth about $310,000 now, and my mortgage has about 14 years left to go, and the balance is about $47,000. That's what inflation does to the 30-year fixed rate loan. About midway through the 30 years, his loan was 15% of the value of the home. It's like it's not there anymore. I told him, look, you're only 58, you're a successful doctor, just let the home sit there, let inflation kill the loans even more. He said no. He sold 3 of the homes, paid capital gains, with the rest he paid off the little tiny 16 loans. And now he had 16 free and clear homes in Phoenix. And he said, I know I'm only 58, I know I'm a doctor, but with 16 homes free and clear in Phoenix, I'm not working anymore. And he's not working, he's done. There are thousands of such stories, and people never think about it. I was connected to Warren Buffett in 2012. He wanted to buy a significant number of homes. Never thought about what the meaning is of having a 30-year fixed rate loan. Why? Doesn't speak with an accent. Of course, he's a brilliant guy, and when I explained it, he got it in a nanosecond. Warren Buffett said, to me, I'm never putting more than 20% down. You think he can afford to put more than 20% down? Of course, but he's too smart. When they give you such a gift, you got to take it. This transcends everything. People talk about short-term and long-term and, Airbnb, apartments. 30-year fixed rate loan in this wonderful, crazy country called the United States will transform your future, and hardly anyone thinks about it. It becomes the job of a guy that speaks with an accent to highlight it. Now, on what type of property can you get 30-year fixed rate loan? Only on 1 to 4 residential units. So now I come to single family homes. People feel that single family homes are only where you start. And then you graduate and you buy fourplexes, and then you graduate to apartment complexes and commercial. I never graduated. I'm not saying in my 36 years of doing this, I haven't bought 25 apartment complexes, land, and developed and commercial properties, but single family homes are the core of my own investment. Single family homes are the most liquid real estate there is. If you go to sell your investment, your potential buyer is everyone in the marketplace. Single family home is still the American dream. You may argue that in places that are expensive, like the San Francisco Bay Area, that dream is not attainable for most people. But there are many wonderful, big, strong cities in the country where it's quite reachable. You can buy homes for less than $200,000, brand new, in good areas. Single family homes usually call for tenants that are a family with kids. The kids go to school. That's like putting roots in the ground. It's more stable. The management of single family homes is so simple that I have people that live across the ocean who bought more than 2,000 homes over the past 30 years or so, and they own a nice portfolio of single family homes managed by property management, and they live 8,000 miles away. I live in the San Francisco Bay Area, and out of the 400 homes I bought, I still own about 150. I absolutely do not spend time on my homes. I have a part-time bookkeeper handling the mortgage payments and that, and property managers handle the homes. I can assure you, if I were really taking care of my own houses, I wouldn't be speaking to you right now at this meeting. I'd be hunched over a toilet fixing it at this very moment. The homes would be taking over my life. Not acceptable. I want to enjoy the benefits of the home, the massive wealth that they build, not in one day, but over the years, in 10 years, 12 or 14, and I'm not willing to spend time. I was working at HP Labs and doing research at Stanford, very busy. The main condition for me was to buy investment homes without it impinging on my time. And the infrastructure that I created for my friends at first and everybody else has made it so that we can all invest in good places and not have it really take up our time. Another email that I got about a year ago was from a guy who is 81 years old. Well, this year he's 82. He tells me, I started investing at age 60. I was a high school teacher, never thought I could retire because I was getting paid so little. With the 6 homes I bought, I'm now retired for 7 years. Thank you, changed my life. Thousands of stories like this. These homes can send your kids to college. You have a small kid, buy a home. Get a 30-year fixed rate mortgage. You want to pay it off in 16 years? That's fine. Make an extra principal payment. Now the kid is of college age. The home is free and clear and should pay for the college because the home does keep up with inflation as opposed to the mortgage and should pay for college. Want to send your kid to a more expensive college, to a Harvard? Buy 2 homes, etc., etc. These are future changers. Now, where should we buy the homes? So I have simple criteria. For decades now, I've been a student of the demographics in the US. And if you look at the census, it's very clear that the demographic growth goes to the Sun Belt states. These are states like Nevada, Arizona, Texas, Oklahoma, Louisiana, Georgia, Florida, where the sun shines. As it happens, as an extra bonus, the Sun Belt states are also very pro-business, which means also nice to the landlord, unlike the state of California, New York, and some other states. Sun Belt states, that's my first criteria. Second criteria, large metropolitan areas. Why? Why large metropolitan areas? That's very clear. Diversity of jobs, diversity of factories and companies. If you are in a very small town and the only major factory in town goes out of business, not so good. So large metropolitan areas. And I'm not shy to buy in the suburbs where families live and the kids go to school. So Sunbelt states, large metropolitan areas. Third criteria is where the numbers work. Phoenix, our biggest market, doesn't work as of June 2020. The homes are too expensive relative to the rents. Prices in Phoenix from 2012 until now rose 160%. At the same time, rents only went up barely 20%. The numbers don't work. Phoenix is a great market to be a seller now, but not a buyer. Same is true in June of 2020 for Vegas, Dallas, Austin, Houston, San Antonio, Nashville. They're too expensive relative to the rents. In Texas, you have to be a little careful also. The property taxes are extremely high. Those of you in the state of Oregon are familiar with that. So which markets work in June of 2020? Well, several do. Let's look at one, the Oklahoma City market. So if you look at the map, you see that Oklahoma City is relatively close to Dallas, yet the prices are quite a bit less than Dallas. The rents are just a little bit less than Dallas. The property tax are 2.5 times less than Dallas. Up until the coronavirus, the unemployment was the lowest in the nation at 2.6%. And even now, the employment is extremely good. I will talk about the COVID-19 and what it does to us. You can also look at it in short videos I put on my website. But this is a very strong market. Even now, through the COVID-19, the occupancy rate is 97%. And I'll say one comment about COVID-19. Even in April, the property managers in Oklahoma City started to say, we are seeing more tenants come to our single-family homes than usual. And they discovered tenants wanted to leave apartment complexes where they didn't feel safe on the social distance because you share the elevator, you share the stairwell, maybe in some buildings you even share the vents. If the tenant in Unit 2B is sick, the whole building is at risk if the vents are being shared. Laundry rooms might be shared. So they're seeing tenants leaving apartment complexes and seeking single-family homes. So Sunbelt states, large metropolitan areas where the numbers work. One example is Oklahoma City. We are buying brand new homes in Oklahoma City. I'll explain in 1 second why brand new homes and why they have a great benefit. From a price range of between as low as $150,000 up to about 190 something thousand. Most of them reside in 170, 180, 165, and the rents are quite strong. That home that we are buying for 180 will likely rent for more than $1,450 a month with very low property taxes in a strong market. So that's a market that works quite well. The Baton Rouge, Louisiana market is a market that also works. I think I own about 15 homes there. Rents are high relative to the prices. And then you have Central Florida. Orlando itself and Tampa itself are too expensive now. But the area between them is a growth area with decent prices. Also east of Orlando, south of Orlando, and north of Orlando, they are very good buys. Prices are different. They are between about 200 to maybe 230. And then another market are parts of the big Atlanta market. Atlanta already has a lot of parts that do not work quite well, but some of them work. And then our most expensive market is the Raleigh-Durham Research Triangle in North Carolina. We're buying homes there anywhere between $200,000 and $260,000. Now, In every one of these markets, I'm buying, I own homes, my friends are, my investors are, which means we have a local property management firm managing our homes. Going back to the Oklahoma City example, we've been buying in Oklahoma City for 16 years now, and we've bought over 1,600 homes. So even if you buy one home and you feel, well, I'm a small investor, the service providers, again, like I said in Vegas at the very beginning, the property managers, the brokers know that if you are not happy, we will get involved, me and my staff, and they could lose 1,600 homes. It's nice to wield this kind of power. It's yours to use. I like to help investors and hold your hand. And I will answer a candid question which you didn't ask, but you thought. Mr. Gorell, if you've been buying homes for more than 35 years and you own hundreds of homes and you bought them with 30-year fixed rate loans, why are you on this call speaking to us? Why aren't you in the yacht in the Caribbean right now? Well, to be on a yacht in the Caribbean now, I can't because of the COVID-19, but yeah, I could have retired more than 20 years ago. And I'm not one of those people who think that being work-free is fun. I like to work. I love what I'm doing. I've changed the lives of thousands. Maybe I'll change your lives. I enjoy this. I love talking to you now about something that I'm passionate about. I wrote 5 books. I made a television show, and then another one. I love working, but I don't have to. So I make it a point to dedicate more than half of my time to meeting people by phone or Zoom, usually by phone, and I would be delighted to speak to you specifically about your case. Every case is different, but the whole point is you can get the 30-year fixed rate loan. That's a miracle that nobody really puts some thought into why it's a miracle. But that's a life changer right there. You don't have to go any further. And as it happens, single-family homes are easy, very easily manageable, and could be remote controlled. Now, here's another question that I get. Okay, if you connect us to the people in those markets, and I get all this power because you bought 1,000 homes or 1,600 homes, do I need to pay you? And the answer is no, you don't. No, you don't. And so the next answer is, to be fair, because this is what people think. Well, if we don't pay anything, how do you make money? Think about you wanting to buy a home in San Francisco or in Portland or in LA. Normally you would retain a realtor that will find you a home, you'll buy it. At the end of the transaction, the realtor gets paid. By whom? By the seller, not by you, the buyer. Same thing, again, going back to the same example of Oklahoma City. When the transaction is over, the broker in Oklahoma City gets paid by the seller. They split it with us. I know it's not much, but I don't care. First of all, I don't have to work. Second, volume. Now, why brand new homes? I know it's so tempting to buy junky homes in junky areas because on paper, the numbers look better. Buying a junky home in a junky city, in a junky area, on paper will show likely much higher cash flow numbers. And nice new single-family homes on paper will not show the same kind of cash flow. Well, guess what, guys? Life doesn't happen on paper. In real life, nice new in good area trumps, and I don't want to use this word lightly here, the junk. And some people say, no, but I bought an old home, I know, but they fixed it. They fixed it very well. Did they fix the pipes deep in the ground that are 50 years old? Oh no, they will burst. I've tried everything. I started out when I was young and doing it as a cash flow cowboy, looking for so-so homes in so-so locations. Took me years to realize location, location, location didn't happen by accident. You want to buy in good areas. You want to buy new homes. They come with a warranty. Manufacturers on parts of the home and builders. They start their life without problems. They have the most modern floor plan, the more energy efficient. Negotiating with builders when you are a large group that buys, you get better deals because builders say, I know you're going to give us a lot of business probably, so I'm going to throw in the appliance package and the covered patio and give you a special price. Brand new homes are only beneficial. Some people will say, yeah, but they cost more. Not really. They don't. So I would advise buying brand new. Now, what about duplexes and fourplexes? Normally, I like the single family homes better. Why? Suppose that you and I are driving in a car in a nice market, in a good area. What are we going to be seeing in the streets in the nice, good area? Single family homes. Now we want to see the duplexes and fourplexes. We're going to have to drive to another area of town. And there are going to be many duplexes and fourplexes. It's going to look like it. It's going to appreciate like it. It's going to behave like it. Management is more difficult because of the proximity. But most importantly, the area is likely not to be as good. In Oklahoma City, actually, the team convinced the builders to build duplexes in good areas. So that does make it closer to the single family homes. I have to tell you, the way I measure the quality of an investment is not only cash flow. Cash flow is one component. The way I really manage is IRR, internal rate of return over the entire investment. So I buy a home or another property, I hold it, I rent it, then finally I sell it. Now I have all the numbers. I can plug them into an Excel and get an IRR. Newsflash, I never made less than 15% annual IRR on single family homes. When you count everything, including the sale, including everything. Single family homes are stellar. They give the best results usually. They are easy to manage. And they get the magical 30-year fixed rate loan. If you can buy duplexes in a good area, that's okay too. But the minute you exceed 4 units, you don't get the Fannie Mae 30-year fixed rate loan anymore. Now you get commercial loans with yield maintenance and defeasance and all kinds of things that those are words I hope you don't even know what they mean. Now, I advise you to make use of the Fannie Mae loans that you can get, those 30-year fixed rate loans. Fannie Mae limits you to a maximum of 10 loans, including your principal residence. I remember a very cute moment with Warren Buffett when he got very excited and said, I want to buy a large number of homes for Berkshire, but I want to get a 30-year fixed loan on each and every one of them. And then he said, I talked to Fannie Mae and they said I can only get 10. That was very cute. Fannie Mae is so smart that it will limit you at 10 loans, whether you are a truck driver from Fresno or Warren Buffett. Geniuses, aren't they? However, some of you in this meeting may be married. If you're married and both spouses work and both spouses can qualify separately, Fannie Mae allows you to take the ownership to the home in both of your names as a married couple, both of your names, but you can put only one of you on the loan as qualifier. If you do that, the limit will be raised from 10 to 10 times 2, 20. So just something to consider. If you want to know more about it, I'll always be happy to, elaborate. I'll be happy to also share a link to the TV show that I made on this very subject and to share, the articles I write for some investment magazines about all of these topics. But it doesn't have to be complicated. People love to complicate. I have friends who've been going to meetings for 20 years and hardly own anything at all. We feel like we need to complicate. We don't. Buy a nice, good single-family homes in a good, strong market where you can buy it for $200,000 or less. Have a property manager manage it for you. I'll be happy to be there supporting you with my company. And then just sit back and do the hardest action for a human being to do. Nothing. Doing nothing is difficult, but that's all you have to do. Some people say, but what do these homes do in a recession? Let's look at the big recession of 2008 through 2011. In many markets, not all markets, but in many markets, houses went up in the boom from 2004 to 2006. Then they completely tanked and crashed in the recession. I've been through 4 recessions in my history. Do you know what happens in every recession? Rentals get stronger. Buying is not strong. Do you know why? Suppose you have a home, a rental home, and you have tenants in the home, and they're saving up money to buy their own home, their dream. And they would have, but then comes a recession. Everybody's scared, the media is scared, everybody says, in that home, the tenants are saying, honey, those conversations usually start with the word honey. We were planning on buying a home, but there's a recession. It's 2009. I'm scared. I may be laid off. This is not the time for us to buy a home. Let's remain. They need a home, so they remain. The kids go to school. I found during every recession I've been to, the rentals were stronger. My houses were fuller. When were the rentals the weakest? During booms. In the big boom of 2004 through 2006, again, the tenants said, did you read in the newspaper? Did you see on the web? Everybody's making money. There is a big boom. Prices are going up. Let's buy, let's buy. And then they buy their own home and you lost the tenant. So very paradoxically, rents are worse during a boom and better during a recession. So what's the solution when you own homes or other properties during a recession? Do nothing. The hardest action for a human being to do. Nothing. Daniel, I would love to take some questions. I don't know how you guys work it or how much time we have. Clearly, I have a lot that I can cover, but
Yeah,
you tell me what we do as far as questions.
I was looking for an opportunity to interrupt you.
I'm
We
so
do have a
sorry.
number of
You can
questions.
interrupt me anytime.
You were doing great. I didn't want to. But we do have quite a number of questions, and I apologize if I'm not going to get to your question. The first one here is, was it possible to cash flow even with 5% down in Vegas, especially with PMI kicking in?
Lovely question. And in fact, you beat me by about 3 minutes or so. When I began to invest in the 1980s, interest rates on mortgages were, are you sitting down? 14%. 14. So if I was buying homes in Vegas, which I was, for 10% down or even 5, and with PMI, and at 14%, you don't have to be a great mathematician to know every single one of the homes I bought that year started with a negative cash flow. Remember, the homes were not expensive. I bought them for less than $40,000, but they each ran a negative of about $200 a month before taxes. I was a single guy working in Silicon Valley, getting paid very well, low expenses. I had no trouble covering the negative. Also, the tax laws were different back then, and after the deductions I could take against my salary, back in the day it was like that, the negative was only about 100. My vision was very clear. I said, I am fully cognizant of the power of the 30-year fixed rate loan. Even at 14%, it'll never change. So maybe now I have a net $100 a month negative per home. But in a year or 2 or 2.5 or 3, since the rents keep up with inflation, but the mortgage doesn't, it will get to break even. And then it's only going to get more and more and more positive. That's exactly what happened. After a couple of years, my homes became break even. Every home that got to the break even point, I popped the champagne. I said, from now on, this home is only going to get more positive. If I can go back in a time machine to that same exact time, I would buy another 1,000 homes if I could afford to pay all the negatives, of course, up to the limit that you can. These homes that I bought with 14% and 5% down or 10 and PMI changed and made me wealthier the first. So the question is very good. Of course, I refinanced when rates went down to 12 and then to 10, and then you guys are on this line during the time where the interest rates are the lowest in history. That's it. Last week, rates for a homeowner got to 3.15, lowest ever in history. Investors' rates are higher, but investor rates now are about 4. With good credit, like you guys working with the W2, might even dip into the 3s. Never seen anything like this. So today, Fannie Mae says the minimum down you need to put is 15% with PMI or 20% without. Even with 15% in PMI, given these crazy low rates, you will still have a couple of $100 a month net positive. If you put 20% more. But that was a very good question, and thank you for helping me make this point.
Next question from Glenn. Typically 8 to 10% in rent for property managers. Is this still the going rate?
Yes, it is. So I would say across the country, and I'm in many dozens of markets, the going rate for properties that are less than 200,000 is 10% and maybe even more. In Florida, it can even go to 15% and to 12. Since we are a large group, by the way, when I say a large group, we don't buy properties as a group. I buy my own, you buy your own, it's in your hand. They just know that we're looking over your shoulder and they want to please you because they want to please us. So I use this strength to lower the management fees to the 8% point. These are very good managers. So many of them do charge 10. We lower them across the board to 8. I believe that's true in all our markets. Maybe there is one exception. And yes, so 8%. I pay the 8% lovingly, even though I own well over 100 homes now still. I look at it as if I'm capable of cleaning my own home. I'm not saying I'll do a good job, probably do a bad job, but I can do it. No, I pay cleaners who come and do a much better job than me and free me up to speak to you now. That's how I look at property management. If you do the math, I pay massive amount, worth it, worth it, worth it. And they manage the homes better than I would. Great question though, thanks.
Next question is from Tracy. What is your advice for the Canadian real estate investor, or
Yes.
where fixed rate mortgages are not as long as American banks?
Yes, so I have a branch of my company in a country that is 7,000 miles away across an ocean. There are loans for foreigners. Canadians have a slightly easier time than a foreigner who is very far away. But in the United States, they have the 30-year fixed rate loan. In Canada, I don't remember how long they're fixed for. I think it's 5. But up until the COVID-19, there were quite a few lenders making loans to my foreigners that are 30 years fixed. COVID-19 shut down most of them. I think there is one or two. There are a couple of sources. Get in touch with me and I'll connect you. The down payments are higher for foreigners. They're usually between 30 and 40%. During COVID-19, they may want even 40 or 45%, but there are loans available to foreigners. By the way, if you ran out of your Fannie Mae limit, such as I have, and I have a Silicon Valley guy who recently closed on home number 50, how does, beyond the 10 or the 20 limit of the Fannie Mae, there are lenders who make pretty good loans, almost as good as Fannie Mae, to people with more than 10 and to foreigners. Feel free to talk to me. I'll be pleased to guide you. And I've had a lot of Canadian investors as well. Thanks.
All right, Adiel, we're down to less than 1 minute. And there are a lot of questions. And so I'm hoping that people will reach out and contact you. Can you give your contact information?
Yes, I'll be very happy to talk to you. Send us an email, info@icgre.com. info@icgre.com. My staff will set a meeting with me and you. We'll talk about you. You can join some of our big events. Look at our website, which is also icgre.com. We have a very large event every quarter where I bring the market teams, an expert. I take a zillion questions. The last event was on May the 16th, and it was by Zoom. And it's on our website under icgre.com/events.
All right. Thank you very much for coming and sharing with the Real Estate Investment Club at Intel. And I'm sure people will be happy to follow up with you.
Thank you very much. It's been a pleasure. Great questions. I wish I could have gotten more, but I will.
Thank you,
Thank
everyone.
you.
And we'll be back next week at Friday at noon Pacific and also Tuesday at 11:30 Pacific for the discussion groups. Have a good weekend, everyone.
Thank you.
Thanks. Thanks. Bye.
Thank you.
All right. That was a good talk, Adiel. Thank you very much.
Thank you,
And
Daniel. And I really mean what I said. I truly, truly, I've not had to work for more than 20 years. So this is my work of passion. I
yeah,
feel
I
that
can understand that.
people like to complicate, and I would like to help them simplify. And if they have more questions, I'll be happy to get them on the phone. They can send an email. I really mean it. This has been, my passion now, and it still is, of course.
Yep, yep. And I think we'll end the conversation there. And if you'd like to follow up with me, I'm also available via email. You can contact me as well, Adiel,
Sure,
and
I'd like to
anyone
talk
who's on the
about
line
what you
too.
do as well.
Oh yeah, yeah, absolutely. Thank you. Bye.
Bye.